Good evening. Those joining us on YouTube Live, Nefex Pesa, you're most welcome to today's session of decoding charts. My name is Nobert Kiza, and I'm joined by Mohammed Salat, and we'll be taking you through a technical tool which is known as the Darvas box theory. So this tool is important for traders. It has been in use for several decades now. And essentially, this tool is really used for the purpose of short-term as well as also medium-term trading. We are going to go over it so that we can get an idea about how we can use this tool for us to profit in the markets. So without wasting time, we are going to start. Awesome. So let's get started. So what do you know about this tool? So that's what we're going to start with. We are first going to understand who Nicholas Darvas is. Nicholas Darvas is the gentleman that introduced this tool. Nicholas Darvas was essentially a dancer as well as also a self-taught investor. And he began his journey sometime in the 1950s. And of course, he sprang up into success by using this tool in the 1950s. Towards the 1958 was when Darvas was able to accumulate about $2 million from about $10,000, he was able to accumulate over $1 million from using this tool. So most of the people who we know in the markets have not begun or have not been grounded in trading. There are people who are self-taught. Most of these luminaries you look up to are actually self-taught traders and investors. So Darvas is one of them. He was a dancer, but he taught himself how he could trade. He taught himself how he could potentially come up with a tool that would ideally enable him to make money in the market. So the Darvas box theory is a trading strategy developed by Nicholas Darvas. And of course, as you know, that word Darvas comes from his name. And it is a method of technical analysis used to trade assets, commodities, assets like commodities, currencies, among other financial instruments. So, what is the Darvas box about? The central idea behind this theory is to identify a box pattern that represents an area of consolidation or sideways movement of the asset's price. So, of course, what most of us know as consolidation, or what most of us also know as accumulation. So accumulation and consolidation mean the same thing. What is really happening with those is that we normally find that price is moving in this kind of direction. And what Darvas decided to come up with was that he essentially said that whenever the market has a period of accumulation and accumulation and consolidation, it essentially means that the market players are trying to hold on to a certain asset. But also in the broader market, what it really means is that the price is really just waiting for one big block of order that will essentially move it either higher or lower. Okay. So essentially, that's what Darvas came up with. And the idea with this theory was that he was saying that we have to look for a possibility for us to profit from one end of the box, either on the upper end of the box or on the lower end of the box. So that is essentially what Darvas was focusing on. So when he used the tool, he focused using this tool majorly on assets like stocks, and he was also able to use it on commodities like gold. So if you're trading gold, if you're trading oil, some of these commodities have been traded for a very long time, and actually were used by some of these people when they were coming up with these tools. So the strategy revolves around buying when the asset breaks out of the upper boundary of the box, known as the ceiling, and selling when it breaks below the lower boundary, known as the floor. So now, I know this box might seem like something simple, but it has very important details that have to be understood before you apply it on your chart. Otherwise, it will be unproductive and will not allow you to be able to use it in the right way. Okay, so how do we identify, how do we trade this tool? So the first thing is you need to first identify the asset that has been trading in a relatively narrow price range or a box. Okay. Now, the one which we are going to focus on and which will be our key for study today is going to be BTC USD. And BTC USD, we are going to focus on it on the daily. Okay. So on the daily, we'll also be able to see how BTC USD has been moving in that Darvas box that we are talking about today. So that Darvas box, we are going to be able to look at it. We shall observe how it has been moving. We shall check it out on TradingView. So I'm expecting that you also, opening up your TradingView to be able to monitor and look for this tool there. So now, after identifying the box, next thing we do is we wait for the asset's price to break above the upper boundary of the box, signaling a potential upward trend, or we look to buy the asset when the breakout occurs. So when the breakout occurs above the upper boundary of that box is when you look for a buy, okay? Now, we also set our stop loss just below the lower boundary of the box to limit potential losses. So Darvas ideally had an analogy that in case price action is moving, is distributed to the downside and then starts to accumulate in some kind of a range, what that would essentially mean is that we have a potential change of structure, which is happening here. Either price is going to move to the upside or price is going to move to the downside. The reason why we will essentially look at setting our stop loss somewhere below the box is simply because when we have a break below the box, that is now a change of structure, and we have to make sure that we are trying to stop any further downside or any further loss taking place from here. That's the mitigant of loss that we look out for when you're using this box. So that is on the aspect of stop loss. Now, aside from that, we also continuously monitor the price, assets price, and adjust the stop loss and take profit levels accordingly. So what else do you look out for? We're also saying here that we sell the asset when it falls below the lower boundary of the box, or if just a moment, apologies for that. Or if, okay, something is being blocked, I can't really see the bottom words there. I don't know, Mohammed, if you can see them. Are you able to see them, Mohammed? Are you seeing the words at the bottom there? Sell the asset when it falls below the lower boundary of the box. So if, or if.
I'm not able to, yeah.
I'm not able to. Or if the technical or fundamental signals indicate it's a time to exit. So what this simply means is that aside from knowing what we're supposed to look out for when we're using the box, that is, a potential distribution to the upside or a potential distribution to the downside, we're also adding our technical and fundamental signals because these are important when we are making any trading decision, okay? So we are saying that there has to be some sort of confluence. You have to gauge what is happening on the fundamentals of that asset. You have to gauge what is happening on the technicals of that asset, in addition to also gauging the sentiment for that particular asset so that you can make a well-rounded decision with your trade. So that's what this aspect means right here. Okay, so let's now continue with the next slide. So now this box which we see here is the most recent box that we have been able to get. This appeared on BTC, and we're going to be able to look at that on TradingView in a brief moment. I will also be able to take you through some of the fundamentals that were also supporting that move. So as you can see in this picture here, what we are having here is just a box, okay? This box appeared on the daily chart for BTC USD, and we are seeing that there was accumulation that had been taking place for BTC from April all the way until November. And what we saw here was a nice break to the upside. We saw a very nice break of structure there that showed that the buyers were now in charge on BTC, and we are seeing it, breaking above this box that was at 32,000. And you can see BTC is up over 2K ever since it broke. above that box. So this indication here is simply one that means that this box actually works well, and it also is a very modern tool for using when you're doing your trading. Okay, so we are going to quickly cross over to trading view so that we can have a good look at what this tool looks like when we're adding it to charts. So let's quickly cross to trading view. So I hope you're seeing my screen. I just want to make sure that my screen is now visible. Just a moment. Okay, I think it should be visible. Okay, so what do we have here? We have BTC USD on the daily, and we have a very, very lovely Darvas box that has formed on a daily there, and we have it still moving within that zone there. Okay, so BTC USD, as you can see there, broke above this Darvas box. So this Darvas box, let us just try and check. When we are saying, for instance, we're going to use this tool, what do we look out for? Okay, we are looking for the high points and the low points. Okay, so with my highlighter, I've marked my low points, which are somewhere around here. Okay, and then of course I've marked my high points, which are somewhere around there. Okay, so the kind of structure we saw with BTC was something like this. Okay, and I'm just trying to draw something that you know, is something that I can say is really you know, common price action. Okay, I'm not going to show you something that we normally see you know, on a regular. Okay, this is common price action. You're having price moving in this kind of, you know, range. So this is BTC. So what we have here, is simple. Okay, we have a move. This is where our Darvas box is. Okay, we have something like this. We are marking our points, okay, where we had almost as though structure was going to break, but it didn't, and it remained within this zone here. Okay, so essentially what we are saying is when you have price action, okay, forming in this kind of range where you have it in a kind of a box shape, okay, where you have high points, and there are normally multiple high points and then multiple low points, we are essentially looking for a break of price action or break of structure that's going to allow this asset to move higher. Okay, so what happened with BTC was, if we have our sort of checklist, okay, we have our checklist here, and we are saying first thing is we have our, just a moment. First thing is we are saying we have our high points, okay, and then we have our low points, and we mark the box area covering these points. Okay, then of course the main thing is we also mark the low points for potential trades, that is longing. Okay, in the case of previous distribution to the upside. Okay, so now where I'm saying we mark our low points where we have had previous distribution to the upside, we are saying that in case price now in the case of BTC, if you observe BTC, before I continue making my notes here, let me just mark this here. So if you monitor BTC, you'll be able to see that before BTC moved high, okay, it had previous boxes down here. Okay, and of course now what that meant is if I drag my line here like this, you will see that BTC before it moved into this Darvas box, it was on an upside move. Okay. Now, what this simply means is that when you're looking for buys, you want to mark your low points as potential buy entry points. Simply being that when you're marking your low points as your buy entry points, since BTC has been in an uptrend, okay, and then it got into that Darvas box in a zone that we are calling sort of like an accumulation zone, we want to look for buys at these points. Now, the reason why we are doing that is simply because since BTC initially rose, okay, that's an indication that buyers are actually still active in it, okay? Now, that's one. Now, the other thing we're going to add is when we look at the sentiment, okay, what is the sentiment for BTC? Sentiment is essentially pointing towards a bullish BTC, okay? And this, of course, is linked to the fundamentals, which are essentially indicating to us that there's a potential BlackRock ETF approval, okay? So you see this? So this is essentially how I'm organizing my notes. So I'm organizing my notes to cater for why I'm looking for buy points, okay? But in addition to that, I've also added things to do with the sentiment for me to essentially gauge what things are favoring a buy on BTC, okay? So this is very crucial when you're doing your analysis for any box, okay? You want to make sure you're monitoring what is happening on the fundamentals, you're monitoring what's happening on the technicals, but you're also monitoring what is happening on sentiment. And of course, that will allow you now to look for entry points, okay? Now, in addition to looking for points for you to buy, which of course, in this case, we have marked with our highlighter on the bottom of the box, okay? The point at which you go in for a buy is somewhere around here, okay? And the reason for that is simply because in using this tool, we want a break of structure to the upside or a break outside this Darvas box to the upside. And when we have a break of this box to the upside, that now means that we should now be looking for a buy, okay? And as you can see that when BTC broke outside this box, okay, it has actually maintained price action above it, which is a simple indication that the buyers were accumulating heavily here. And when it broke, we saw a very nice uptrend there, okay? So when you're using this tool, make sure that you have a way you're organizing your notes so that when you're making your decision to go in for a buy or to go in for a sell, you're really having a way in which you're gauging all of these things. So this is very important so that you can make a strong or thorough decision with your trade with regards to how it's moving. So when we cross over to gold, we had a nice box on gold, which was created also sometime, I think, earlier, of course, earlier before it moved higher. And of course, the reason for that was majorly premised on, gold's very strong momentum, okay? So we had our box, I think it might have been on, this box, I think, was formed somewhere around here, okay? So where you see my box here, okay? So there's a box somewhere around here on gold, okay? And you can see that this box was actually a very nice box that was formed on gold. And we saw that price actually hesitated within there before it continued rallying to the upside. So I think this was on a lower time frame. We saw it, I think, must have been on a 45-minute. Let me just see when you made that box. It was somewhere down here. Okay, perfect. Now I've gotten it. It was within here, okay? So this was gold on the 45-minute. And as you can see, gold was also a very nice setup for the Darvas box. This was simply because we had our points, okay? We had our points around here. These were the low points. We also had the high points. And then, of course, we had a nice test of this zone here. And what enabled us to create the box was when we had gold forming here and here. So when it created here and here, that was already a very nice setup for us to now create this box, okay? And as you can see, same thing also with gold. The kind of structure we are seeing with it was something like this. We had an initial move up there, and then we saw it having, you know, that kind of price action within that zone. It moved somewhere like this. We saw it, you know, making such certain moves like this. Next thing you know, it breaks above the box. Okay, so that was also a nice indication for us to potentially look for some buys there, because it was forming a very nice structure, indicating that buyers were still active. Okay, so that is essentially how you can use this box. Okay, and of course, for the case for gold, what we are saying is, in addition to having marking the high points and the low points, those of course are repetitive for any tool. Okay, high points, we are saying you also have low points. Then of course you're marking areas, you're marking low points. Okay, you're marking areas where we have potential trades. Okay, and of course this of course is because you had price distributing to the upside. Okay, so whenever price distributes to the upside, of course that's an indication that you should be looking for a buy on it. Okay, and then of course we are saying sentiment, gold has been bullish. Okay, so when we talk about sentiment in the market, we are saying either it is bullish or bearish. When it is bullish sentiment, that is buyers. When it is bearish sentiment, that is sellers. Then of course we are winding it up with saying fundamentals. We have Israel, we have the Israel-Hamas conflict. Okay, so Israel-Hamas conflict, we're adding up and we are saying gold being a safe haven, okay, presents buy. Okay, so things like that. So when you have your notes here like this, essentially what you're saying is, if you have a Darvas box, but the Darvas box does not in any way agree with the fundamentals, that simply means that if you're looking for a buy, or if price distributed to the upside and you look for a buy, and of course, even if it breaks this structure or outside the Darvas box, you could have a scenario where you have a fake out and you have price, reverting back into the box. Now, if you notice, you'll be able to see that when gold broke outside this box, it did not hesitate above it, okay, to come back below. The structure remained above it. That is a strong indication that, there was something underlying that was allowing gold to move higher. Okay, so I think was well understood. We can now go back to our presentation and wind up with this. So I think with that, I want to allow Mohammed to take over from here. Mohammed, you're most welcome.
Thank you, Nobert. That was a very nice explanation on the Darvas theory. I love the way you simplified it.
And what's your thoughts on gold? Do you think we are going to have gold maintaining its move higher? What do you think? Gold has been a tricky one.
I think gold is a safe haven for buyers, because now whenever there's a conflict, you saw the last time Russia-Ukraine conflict, gold was really skyrocketing. The same thing is happening right now. I believe it was at 1800 last week.
Yes.
So that is roughly 1,000 pips already covered. So I believe gold will continue going up. As per my analysis, I believe gold should be going further and further up.
Yes, indeed.
Although we know the dollar, so they like having a nice fight. They don't like losing the fight. So I believe the gold will still continue buying. Also, back on the Darvas theory, I'd like to share this important guidance a little bit. So basically, the best thing for you guys to do whenever you are trying to look for these boxes, it's better for you to look for these boxes in trending markets. The main reason is because a trending market has enough volatility to break out and push further or lower, break the Darvas box and continue going further up or coming
Yes.
down. Instead of sloppy markets. I really don't like when the markets are too bogus. They are just ranging. Especially this week that we have the NFC at the end of the week. I believe the markets are too slow, ranging. So it's better for you guys to look for trending markets so that you can perform or you can have these diverse boxes performing uh, very well. Also, you choose the correct asset. You can't be choosing an asset that roughly moves 200 pips a day, and then you expect the Davos box to be working perfectly on daily basis.
True.
So it's all about the assets and the timing. I believe so. The timing is very very key because we usually have an Asian range. The Asia session is usually known as the Asia range. So if you want to look for the Davos box, it's better for you guys to set out the Asian range so that whenever we are opening the London session or the London Open, we usually have the Davos box being broken. So you can also try looking for that. Risk management. Okay, risk management is a very very key point in every aspect of trading, not just this aspect of using the Davos box. In every aspect of trading, risk management is very, very key so that you can cut down your losses and have enough or big risk reward ratio so that you can be winning. You can be on the winning side because we usually have traders who are perfect at analyzing the market but lose out because of risk management.
That is very true.
So,
I
so
agree. I
it's
think,
better.
yeah, I think without a doubt, yeah, risk management is very, very crucial because I mean, without it, you can't really stay trading, it takes you out. Yeah. So I think that's very, very important, Muhammad. I think thank you so much for bringing up that point. Yeah. I
Yeah.
think, yeah, I think in a nutshell, yeah, that's very, very crucial information. Risk management is very important. And I hope we are picking up on some of those important advice that Muhammad has shared. That also important that timing. We will have those ranges forming at particular times in the market. With the different sessions, there are always ranges. Okay, so we'll have a range that could have a break of structure to the upside that we maybe can utilize. And of course, if we set our box, then we can potentially look for a trade that could take us maybe, breaking that structure maybe into Euro session, whether to the upside or maybe breaking it to the downside, maybe during the US session. So I think that is very, very crucial and very,
Yeah.
very important information. Yeah.
Yeah, so let me just add up this last point. The importance of adapting a strategy to the changing market conditions. Market conditions are usually changing from time to time, so we cannot have the same conditions that we had when Davos was alive or when Davos was bringing or developing his working system or theory. So you will find that mostly the market conditions usually tend to change bit by bit. So it's better for you to adapt. I love the way Nobert was writing down his notes and noting down everything about the market way before he could take any decision. So that is what we call informed decision. You make informed decisions. So you make sure
Thank
whatever
you.
is happening in the world, you know about whatever is happening, be it fundamentals, be it the sentiment, be it the technical. So it's better you develop a working system whereby you can use the Darvas box theory. You can combine it with other technical theories like a trending market, like an uptrend or a downtrend. Those are technical theories identifying the trend. Then you can use the Darvas box theory to identify where or when to take an entry. So I believe, Norbert, you've done a great job. So thank you also for showing the notes on how to do it.
Awesome. Most welcome. Yeah, so I think that's it I think for this evening. I'm hoping those who've joined us, Bold for Purpose, you're most welcome. Casper, you're most welcome for joining us. Uh, Daniel, you're most welcome. Daniel asking, how about EU? I think EU must have been covered during the snapshot. So you can check out the snapshot, or you can also wait for the snapshot for tomorrow, where we shall provide you guidance on that. So I think that's it from me and Mohammed. I wish you all an amazing evening, and we'll meet again next time. Bye for now.
Goodbye, guys. Goodbye.